You know, every business out there, from a tiny coffee shop on the corner to a massive tech giant, is playing a game, a really high-stakes game. But how do you actually keep score in that game? Well, it all boils down to one thing, a universal language. A language that tracks every single win, every loss, every move they make. And today, we're going to decode that language. We're talking about accounting.
Seriously, just think about it for a second. How does a business really know if it's winning? Imagine trying to play a game, any game, without a scoreboard. You could be running around, making what you think are amazing plays, but with no way to track the points, you're just guessing. A business without accounting is doing the exact same thing. They're just flying blind.
So that scoreboard for business, it's a special kind of language. It's what takes all the chaos, the sales coming in, the expenses going out, all the investments, and it translates everything into a story that actually makes sense. And yep, you guessed it, that language is accounting.
Okay, so why does this matter so much? Why is it so absolutely critical? Well, because accounting is what brings order to what can be a total financial mess. It's the system that takes this jumble of receipts and invoices and turns it all into clear information you can actually use to make smart decisions.
And that really gets to the heart of it all. See, accounting isn't just about crunching numbers for the sake of it. No way. It's a communication tool. Its whole reason for being is to grab all that important financial info and get it into the hands of the people who need it to make those big decisions. Now, what's really amazing is that at the very core of this whole system, there's this one single, kind of beautiful equation. And it's not just some random formula you have to memorize. It's the logical heart that brings this perfect, predictable balance to every single financial move a business makes. It's pretty cool.
So where does this perfect balance come from? It's all thanks to something called the dual aspect concept. Sounds complicated, but it's not. It's the foundation of everything, and it's super simple. Every single transaction has two sides, a twofold effect. Think of it like this. For every give, there's a take. It's this perfect symmetry that makes sure the whole system is always in balance. No exceptions.
And here it is, the star of the show, the fundamental accounting equation. Assets equals liabilities plus capital. That's it. This is the master scoreboard. All it's saying is that everything a business owns, its assets, has to be perfectly balanced by who has acclaimed those things. That's either outsiders like banks, the liabilities, or the owners themselves, the capital. And that perfect balance, it's also an amazing built-in error checker. If the two sides don't add up, you know right away something's off.
Okay, let's break that down real quick. Assets, that's the stuff the business owns. Simple. Cash, machines, the products on the shelf. Liabilities, that's what the business owes to other people. Think bank loans or bills you haven't paid yet. And capital, that's what the business owes to its own owners. It's their stake in the company. Their initial investment plus any profits that have been put back into the business.
All right, let's watch this thing in action. It's like a perfectly balanced scale. So, step 1, the owner puts cash into the business. Boom, the business's assets, the cash, go up. And the capital, what it owes the owner, goes up by the same amount, balanced. Now, step 2, they use some of that cash to buy a machine. Okay, so one asset, machinery, goes up, but another asset, cash, goes down. See what happened? The total value of the assets didn't change at all. Still balanced. And finally, step 3, they buy some goods but on credit. So their assets, the inventory, go up, and their liabilities, what they owe the supplier, also go up. And again, perfectly balanced. See? Every single time, the scale stays level.
Now for this whole language to work, for anyone to actually trust it, everyone has to be playing by the same rules. It's a game, right? You need rules. In accounting, we call these rules concepts, and they're what makes sure the financial story is consistent and, most importantly, reliable.
Okay, one of the biggest rules, a really fundamental one, is the business entity concept. All this means is that the business is treated as a completely separate person from its owner. So if the owner goes out and buys groceries for their family, that has nothing to do with the business. It's a personal transaction. And this rule is so important because it lets us measure how the business is doing without getting all its finances tangled up with the owner's personal life. Here's another big one, the money measurement rule. Just look at this comparison here. Accounting is fantastic at measuring things you can put a price tag on, like a new computer. But on the other hand, it can't measure things like the incredible skill of a new manager or how creative the research team is. And that's a really important trade-off to understand. Its greatest strength is that it's objective and based on hard numbers, but that's also its limitation. All right, so we've got this system for carefully preparing all this information. But, so what? What's the point? Who actually uses all this stuff?
Well, this is where it all pays off. This is where the numbers stop being just numbers on a page and start to come to life, influencing some really big decisions.
Because everyone's coming at it from a different angle. You've got the owner, and they're asking, hey, are we making any money here? Is this thing profitable? Then you've got the managers asking, how are we doing compared to our goals? The bank that lent money is asking a very different question. Are we going to get our money back? And of course, potential investors are wondering, is this a smart company to put my money into? They all have different questions, different stakes, but they're all looking at the exact same data for the answer.
So let's pull all these threads together. You take that perfectly balanced equation, you add in the consistent rules of the game that everyone follows, and you think about all the people who need this information, and what you get is the true purpose of accounting. And that is, simply, to tell a clear, reliable financial story.
You know, this quote here from the American Institute of CPAs just nails it. The whole point is to provide quantitative information that is intended to be useful in making economic decisions. The key word there is useful. It's not just about collecting numbers. It's about giving people the tools they need to make smarter, more informed choices.
So you see, accounting is so much more than just a boring technical chore. It's really the ultimate storyteller for any business. It takes every single action, every sale, every purchase, and weaves it into a narrative. A story of profit, of loss, of strengths, and of weaknesses. So, the question is, what story is your business telling?